Good morning from London. I'm Anna Edwards alongside Kriti, Gupta and Lizzy Burden. We're an hour away from the opening trade. Here's what you need to know. Donald Trump says he'll announce auto levies soon and introduces a new trade threat with what he calls secondary tariffs. But he suggests some countries will catch a break with his reciprocal tariffs. Tesla sales continue to fall in Europe, dropping by nearly 40% in February, while car makers on the continent see a broad drop. Plus, HSBC doubles down on Asia and the Middle East after exiting key businesses in Europe. CEO Georges Elhedery speaks to us exclusively.
A very good morning, everybody. Checking in on these markets, and we have futures pointing lower in Europe and on Wall Street. We've already seen losses in the Asian session. Markets kind of struggling to build on the momentum around that optimism about more measured tariff policy out of the White House. The mood back to cautious on Donald Trump's latest statements. And we have the Hang Seng Tech Index down nearly 2% earlier in the session, now 3.8% down. And this is after suffering from that Xiaomi share sale hitting sentiment. Also, Alibaba's chair warning of a bubble in the AI data center build out there. But finally, just back to tariffs, checking on oil, Brent at $72 a barrel, having climbed yesterday on Trump's threat of a 25% tariffs on nations buying crude and gas from Venezuela. The countdown to the opening trade starts right now.
They've charged us so much that I'm embarrassed to charge them what they've charged us. But it'll be substantial, and you'll be hearing about that on April 2nd. And it will be Liberation Day.
So we have tariffs to look forward to, potentially when it comes to the auto sector, when it comes to the pharma sector, potentially even tariffs when it comes to the energy infrastructure. The very first time that has now been brought to everyone's attention when it comes to the likes of Venezuela. Then you have the geopolitics. Then you have the markets. There's so much to dive into. And, of course, the maybe headlines of the newspapers in the last 24 hours, which, of course, has been this massive national security leak from the United States and the Trump administration as well. We're going to dive into all of the details. Let's kick it off with the tariff story first, because this isn't a new line.
Yeah, there's a lot happening here, isn't there, on the tariff front? So April 2nd, we're still moving steadily, slowly, Kriti, towards that date. Liberation Day, as it's called by the Trump administration, of course. But the fear in markets is, what does that do to American growth? What does it do to pricing in the United States? So as we look for clues around April 2nd, interesting to note that we played that soundbite there from President Trump saying he's going to give some countries breaks because he just couldn't bear to impose reciprocal tariffs that are at the levels that other countries impose. So that's one side of things. On top of that, we have this other news flow around sectoral tariffs. So tariffs on cars, he says, will come in the next few days. Lumber and chips, he talks about coming down the road. So there's this sectoral angle as well as the geographical angle. And then this new policy tool, these secondary tariffs he's talking about. So if you trade oil with Venezuela, be prepared to get hit by a secondary tariff from the United States, just cementing, really, this move away from sanctions as a policy tool towards tariffs that we've seen under this administration.
Interesting that the hit to the car stocks this morning at the open might not be that massive if TradeGate's anything to go by currently. But in terms of these countries who want to catch that break that Trump's referring to, they're scrambling to try and get some relief here. The EU trade chief, Maroš Šefčovič, meeting the US Commerce Secretary Howard Lutnick today. India hosting an American delegation to try and get a bilateral deal here. And we talked yesterday about the UK potentially scrapping or lowering the digital services tax just when the Chancellor needs every ounce of revenue she can get. And just aside from the government reaction, China's reaction, a little opposite, however. Chinese funds saying, if you hit stocks in China with tariffs, we're going to sweep them up when they're a buying opportunity.
Well, let's talk about how this all shows up and for Europe specifically, because pharmaceutical tariffs is the part that caught my eye there. Because he was talking about auto tariffs. We've had this conversation. We'll dig into the details before in terms of the kind of competition of the likes of Ford, GM with Volkswagen, Mercedes, et cetera, Stellantis. The pharmaceutical piece is a Novo Nordisk story. This is a pharmaceutical story where 60% of the revenue comes from the United States. You mentioned the Venezuela piece of this as well. China, India, the second and third largest oil importers of the world, are the ones that are going to get impacted by potential tariffs if they are indeed talked about. And that all comes with the Iran risk as well, something that, to Lizzy's point, hasn't shown up yet. I'm going to circle back to the autos perspective because you have tariffs on the one hand, you have Chinese overcapacity on the other. And it's already showing up in the data. European car sales dropping. Tesla, which is, of course, an American company, also not boasting very good numbers.
Yeah, exactly. So the overall European story is one of negativity. This is gas and petrol are down, diesel down, EVs are up, but that hasn't helped Tesla. Tesla down by 40%. This is a year-on-year figure for the month of February, and that compares to the overall trend for cars, or for EVs rather, being up 26%. So Tesla really, really underperforming, and perhaps no surprise when you see the sort of strident tone that their CEO has taken on. Lots of politics in the States, but also plenty in Europe as well.
Yeah, and potentially there is a boycott effect here on Tesla cars because of Elon Musk's association with the Trump administration and his role at Doge. Interesting that the Tesla chair has said, really kind of dodged questions on whether Elon Musk needs to devote more time to the business, whether he's being distracted by all of the politics. But on the flip side, Cathie Wood telling us this morning at the HSBC summit, she's still very much bullish on Tesla, and she sees the stock hitting $2,600 in 5 years. So very much keep an eye on that in the pre-market.
OK, and let's move on to some of the geopolitics that Kriti was talking about and the sort of water cooler story of the moment, I'm sure. And this is the setting up of a Signal chat group that involved plenty of US administration, security staff, really top level, the vice president in there, defence secretary and the rest, and including a journalist as well, Lizzy. And clearly this is something that's going to dominate US politics. Democrats, of course, saying this is outrageous. But also there's a European angle here, because a lot of what they were saying is that message we've heard before about how Europe needs to do more to protect itself.
Yeah, well, calling us pathetic freeloaders, in fact. And this is the message that we heard at the Munich Security Conference, but significant that this is what's taking place behind closed doors as well. So there is that, but there's also the question of whether the Europeans should be sharing intelligence with America, although, as they point out, that flow is very much more in the other direction.
It's the key line, and you brought this up in the pre-meeting as well, is that something that specifically came from J.D. Vance, according to this article, was that 40% of trade in that Suez Canal, or excuse me, between Europe and Asia passes through the Red Sea. And that was the argument that they were making. It also comes back down to kind of where we were talking about with tariffs, that trade is the pinpoint of all of this. The security concerns are one piece of it, but for an economic audience and for an international audience that is keeping an eye on that part of the world, that's the fact, and that's the statistic, even that they're looking at not only on a national basis, but on a state-by-state basis, because part of that conversation as well was J.D. Vance going to an event in Michigan, for example, where even in Michigan, he said how much of that state's economics is tied to that of Europe. And those are the nitty-gritty details we haven't heard in previous administrations.
Yeah, it was interesting to listen to how they were talking about the messaging, how this would land, how they would convince the American people that this was something that they needed to be involved with. So that was interesting. To your point about sharing of intelligence, I thought that was interesting. But also the line, it goes a little bit further, I suppose, than the security conference detailed, although, you know, a lot of this is not a surprise because of what he did say in Munich. But they did talk about, you know, basically sending the bill to Europe, so being able to recoup this somehow. So we'll obviously be looking for seeing that coming back to Europe in further conversations with the United States.
Absolutely. Ripple effects that we are very much going to be keeping in focus. In the meantime, if you're wondering where our very own Guy Johnson is, don't worry, he's around. He's just in a different country. Airbus CEO Guillaume Faury reiterated his call for European countries and companies to rally together on common defense and space projects to improve security. Take a listen.
We need a demand at scale. We need countries to come together with a common need, and we need the industry to come together to supply. So Europe needs scale. In terms of technologies, we have very similar technologies, but it needs to go into a project at scale.
How quickly can you do that?
Well, it's going to take a bit of time. We are moving as fast as we can. We have indicated that we are in discussions with Leonardo, our friends from Leonardo and Thales, to create a joint company for satellite manufacturing.
Bloomberg's Guy Johnson at the Airbus Summit in Toulouse. Guy, walk us through what you discussed with the Airbus CEO and what you're looking forward to later.
All right, we've got a lot to discuss. Yeah, I caught up with Guillaume Faury last night. Fascinating conversation, talking about the fact that we basically need an Airbus of defence. We need an Airbus of space. He indicates, and he indicated there, that we do have the capability in Europe. We just don't have the consolidation, and that fragmentation within the European space industry, within the European defence industry, is what now needs to be resolved, and resolved quickly. Conversations are clearly happening. He talked there about the space aspect of what he sees going forward for Airbus, how he sees Airbus going forward in that area, talking to other companies at the moment. Clearly, there is a desire in Europe to take Starlink off the agenda. We've just been talking about Tesla and what is happening there. Europe wants to get rid of another business potentially as well of Elon Musk, and that is Starlink, and replace it with a homegrown operation. Guillaume Faury says the capability exists here in Europe. We just don't have it at scale at this point, and that is the real challenge going forward from here. It's a similar story in defence as well. There's talk here about big orders potentially coming down the pike, that there's significant need for heavy lift capacity for Europe's militaries if they are going to gear up and present a challenge to Russia. So it is really interesting. Over the last few years, Airbus has been seen as a civil company. It increasingly wants to be seen as not only a civil company, but other arms of the business also coming up to scale as well, particularly, as I say, space and defence. On tariffs, he worries that actually he could see Airbus coming out of a tariff war better than Boeing. He's not worried about it, but he does see that challenge potentially coming for Boeing. Airbus manufactures around the world. It has a big footprint in America. It has a footprint here. It has a footprint in Asia. He thinks that might insulate him a little bit better, but he says it's too early at this point to talk about tariffs. He doesn't have a clear view of what is happening, and as a result of which, he's very much in wait-and-see mode.
Guy, thank you very much. Guy Johnson, of course, on the ground there at that Airbus event. Much more from him and that interview with Guillaume Faury as we go through the programme. Other things on the programme today, we'll have the markets covered from all angles. We'll speak to Sophie Huynh, BNP Asset Management Portfolio Manager and Strategist. We'll also be joined by Iain Steely, JPMorgan Asset Management International CIO of Fixed Income. So we'll get that fixed income perspective from him. We'll also speak to Gerry Fowler, UBS Head of European Equity Strategy. Just what do global flows in equities look like right now, as the second half of March seems to be marked by something of a comeback from US stocks?
Absolutely. In the meantime, let's walk through some of the other data points that we've got over the next few hours. At 9 a.m. UK time, the German IFO data is going to be hitting the wire. At about 12:30 p.m. UK time, though, the focus shifts to the United States. Fed Governor Adriana Kugler is going to be giving an economic speech at the U.S. Hispanic Chamber of Commerce. Just 30 minutes later, the spotlight falls on New York Fed President John Williams speaking at the New York Fed conference as well. And then, of course, the data continues. At about 2 p.m. UK time, U.S. consumer confidence data is going to be hitting the wire. We keep talking about this tariff impact, how that's going to be showing up in some of the playbook. Are the consumers feeling it yet? Are they getting nervous about it yet? You see it in inflation expectations. Does consumer confidence continue to take a hit?
Yes, I seem to remember getting really excited about the last set of consumer data, as advised by lots of our guests, saying this is going to be crucial. We're going to see some weaknesses here. We didn't quite get that, so we'll see. Is that just delayed? We'll see whether that comes through soon. I'm interested in the IFO number as well. That's coming out of Germany. So we've already had the ZEW. That was last week. That gave us the kind of investor sentiment boost that we had expected to see and did see around Germany's spending plans. Today we'll get the business sentiment, so that's the IFO survey. What do their expectations, what do German businesses' expectations look like? I think that could be interesting.
Yeah, and of course we already had the PMIs yesterday showing this pickup in Eurozone private sector, fuelled by the recovery in manufacturing, particularly in Germany. So do we see a continuation of that in these numbers as well? We've also got to keep an eye on Turkish markets,
yes,
of course, today. We've seen such a rout, given the political context around the Istanbul mayor being arrested, major fallout in the lira. The finance minister is going to hold a call with international investors today at 1 p.m. London time to try and calm these markets. But you've got to wonder, can markets stabilise if the politics hasn't stabilised?
Yes, well, to what extent is Mehmet Şimşek, the finance minister, going to have a free rein here? Certainly Erdogan giving him his backing, the lira stabilising a little bit in yesterday's trade after Erdogan backed Şimşek and his policies, and he seen as crucial to some of the gains that Turkey, or the recouping of the Turkish reputation that we've seen over the last couple of years with slightly more conventional monetary policy.
Yeah, I mean, there's a quote from Erdogan saying the heated debates in recent weeks have shown that European security without Turkey is not possible.
Yeah, the other link.
Very, very aware of his position here with Trump and Putin on the rise and Europe so desperate for that security backing. But let's get to what else you need to know this morning. HSBC CEO George Elhedery plans to double down on investment banking operations in Asia and the Middle East after exiting key businesses in Europe and the US. The bank's restructuring is set to save $1.5 billion in efficiency costs and enable investment in areas with a competitive edge. The CEO spoke to Bloomberg about that shift.
We want to double down on all our capability around debt. That's debt capital markets, leverage acquisition finance and other financing activities, because that's the heart of everything we do globally. And in regards Asia and the Middle East, we want to also double down our capabilities in M&A and ECM.
Elsewhere, the UN is asking 1/3 of its international staff based in Gaza to temporarily leave over security concerns. Hundreds of civilians, including a UN worker, were killed last week by renewed Israeli strikes in the Strip. The Israeli military, meanwhile, says it's intercepted projectiles launched from Yemen and northern Gaza as well in the past few hours. And US and Russian officials have met in Saudi Arabia a day after American and Ukrainian teams held talks. The discussions focused on the safety of navigation in the Black Sea and potential maritime ceasefire, with the goal of achieving a broader and more permanent peace deal. Ukraine's envoy to the US tells us Kyiv would unconditionally support a full ceasefire.
And, of course, something that we're awaiting a statement for as well, at least later today. Coming up on the program, though, our very own Guy Johnson will be back, joining us for an exclusive interview with the Qantas CEO, Vanessa Hudson, from the Airbus Summit in Toulouse. Plus, UN nuclear watchdog chief Rafael Grossi will be joining us for a status update on Ukraine's energy assets and prospects for a new Iran nuclear deal. But first, let's talk about the markets. Market sentiment continuing to shift on trade war concerns, but we're also going to check out on the impact from the latest Fed speakers. All that and more coming up. If you have any questions of your own or for our guests, dive into the conversation. IB plus BBTV Go is the function on your terminal. This is Bloomberg.
Welcome back. This is the opening trade, 7.19 here in London. Now, the US stock sell-off has been easing of late, and yesterday's driver was reports of a potentially more targeted approach to tariffs from President Trump when it comes to his planned actions on April 2nd. Let's bring in Bloomberg's Valerie Teitel, who has more for us. Valerie, US stocks actually since the middle of this month have been recovering their poise just a little bit. We saw that in evidence driven by trade news flow yesterday.
Yeah, yesterday, Anna, S&P 500 notched its third best session of the year, rising some 1.8%. And take a look at the sectors on the move. The consumer discretionary sector actually had its best session since 2022. What is this telling us? I think this is really maybe an unwind of the recent bearish positioning in the equity market. Maybe these worries over a economic slowdown being unwound, because we also saw it happening in the Treasury market. Treasury yields rising across the curve yesterday. The move in the 10-year yield rising some 9 basis points in yesterday's session. It was accelerated, actually, by a beat when it comes to the services PMI. And I think this just echoes, Anna, a recent string of beats when it comes to economic data. Yes, we have had misses when it comes to manufacturing, but when it comes to services, when it comes to the housing market, we are still seeing solid economic data. And I think the market is going to start to wonder just how quickly maybe the narrative could shift of one of economic resilience in the face of tariff uncertainty instead of one of an economic slowdown.
Valerie, thank you very much. Bloomberg's Valerie Teitel with the latest on the data picture and risk sentiment. Let's put those questions to Sophie Huynh, portfolio manager and strategist at BNP Paribas Asset Management, who joins us on set this morning. Sophie, nice to see you here. Thank you for joining us. So do we need to think carefully about the weakness that has been the narrative for the US markets of late? Because actually, in the last week or so, we've actually seen US equities trying to rebound. Some of the data's been better than expected, as Valerie has said. Have we overdone the negativity around the United States, do you think?
I think what's been priced, at least since early December, was just cutting this US exceptionalism. I think post-election, people were expecting the write-down risk to materialize with the reacceleration of the economy. I think at this point, given that the focus has been much more on tariff, now this write-down risk can be totally discounted. So we're back to the normal cycle where we're probably going to have a slowdown given the latest stream of economic data. And even if we exclude the surveys, which are politically biased, the bottom-up earnings as well revisions are not positive. So we think that it's going to be a normal economic cycle, slowdown, probably recession, but not priced yet.
Well, that's interesting. Normal economic slowdown or recession? Which do you think it's going to be?
I think at this point, if you look at survey data, it's more like the soft landing scenario. But I think we need to price a bit more the left-tail risk, given that the tariff uncertainty is not supportive for the economic outlook. It has an impact on hiring plans, capex spending, M&A, and this uncertainty is going to be bad. So the slow dripping of tariff news, I think, is worse than like a whole announcement at once.
What about the idea of just kind of the chaos domestically within the United States? There's a piece over the weekend of the FT that suggested that perhaps weakness in the dollar is less a story of reciprocal tariffs and more perhaps of a change in how the rest of the world is viewing the safety of the United States. Are you seeing evidence of that mind shift when it comes to the financial markets?
I think I totally agree with you in terms of the perception of the dollar. If you look at what happened and the dollar strength we've got for a decade now, the dollar has been used in trade receipts. It has been the main beneficiary of globalization. Now, if you put tariff on the table, what's going to happen? I think that the premium attached to the US dollar versus interest rate differential is going to keep fading. And that's why medium term, we're rather bearish on the dollar.
Dive into those dynamics, though. You said the interest rate differential is fading with the dollar. I'm looking at yields that have only been climbing 433 on the 10-year. Why is that disconnect spreading between the FX market and the fixed income market?
I think the rates market at this point is being very sticky because it's reflecting to some extent stagflation fears. So if you look at, for the past 3 weeks, whenever you got equity sell-off, you didn't have that much rally on Treasury. So I think the rates market is pricing another story, when FX, on the other hand, is like trying to discount this US exceptionalism further, and the fact that if you think about the dollar smile, the dollar might not benefit as much from a broad risk-off than previous cycles.
So if you're worried about a US recession, how do you hedge internationally around that risk?
Yeah, so asset allocation-wise, I think that at the moment we have already a lower equity exposure compared to a couple of months ago, and that despite the negative equity bond correlation. And I think it's because of the fact that we think the Fed puts it's much lower at this point because of stagflation. And then I think in terms of the equity allocation, we much prefer to diversify. So we've seen this rotation into Europe, we've played out. But I think what's more important is having some Chinese equities in your portfolio. Yeah. Because we think that at this point, the shift that we've seen last year is quite material. Yeah. Consumer demand boost, the fact that we got this priority towards the strategic industries, and we saw it with DeepSeek. So they have fully embraced the decoupling from the US, and this, I think, independent supply chain is starting to play out, yeah. And it looks smart compared to Europe, for example.
Yeah, I was going to ask you about the she put. Is it just tech that you would be buying in terms of Chinese equities, or is it broader than that?
So it's broader, as in like, so in our portfolios, we're holding A shares, H shares, as well as China tech. I think what's interesting is the rally on Chinese equities was mainly on H shares, but now that we have the AH premium that have normalized, we think that the Chinese equities rebound will continue as the underweight in Chinese assets continues to normalize, and we think that across the different shares it's going to benefit.
Okay, really interesting. I mean, we're seeing Chinese shares kind of suffering today, partly because of the tariff story, partly because of the latest tech news there, but you're optimistic in the longer term. Really good to get your views. Sophie Huynh, portfolio manager and strategist over at BNP Paribas Asset Management. Always good to have you around the table. We thank you for joining us. But coming up on the programme, we're going to take a closer look at the direction of the bond market. Iain Steely, International CIO for Fixed Income at JPMorgan Asset Management, will be joining us as we look at the Treasury yields. Pretty steady on the 2-year, higher a basis point at 4.04% and steady on the 10-year as well. Stay with us. This is Bloomberg.
We are 30 minutes away from the start of the opening trade. Futures, equity futures, do look like this. They are positives with outperformance over in France, but higher by about 0.2%. We'll call it 0.3% over in the French index if we're feeling lucky about it. The good news is that there's some positivity, perhaps a kind of outperformance relative to the United States and, I should say, Asia as well. But is the bond market matching that sentiment? Let's take a look here because we are, of course, awaiting some of the early reads on that bond market. 30 minutes away from the gilts open as well. I'm looking at a 10-year at 434 when we start moving and pricing in perhaps some of the tariff read. We're also seeing about 1 basis point move higher in the German 10-year, the French 10-year, and the Italian 10-year as well. Again, marginal moves, but enough maybe to point us in the right direction. Let's get a little bit more on that bond market. Joining us now, Iain Steely, International CIO for Fixed Income over at JPMorgan Asset Management. Iain, a pleasure to have you on the program, as always. Thank you for joining us. The tariff headline of the morning is autos, pharmaceuticals, maybe a little bit of oil if you are a country that trades with the likes of Venezuela. Should the markets be trading, should the bond markets be trading on the expectations of April 2nd off the tariff induction or April 5th off the payrolls report?
That's a good question, actually. I think a little bit of both, to be completely honest, because I think what the bond market, what we saw yesterday was that we had the headlines kind of over the weekend and yesterday early morning that maybe the tariffs weren't going to be as stringent as was feared sort of late Friday. Obviously, bond market sells off. I think we're going to have this sort of back and forth on the tariff headlines. I think that is what we're going to trade. If you do take a step back, though, and you listen to what the Fed said last week, they're obviously very concerned about the growth picture. And really, the survey data they're dismissing for now. They'd like to see what happens in the hard data, and that's going to be the jobs report, and that's going to be the employment picture. So I do think you want to be taking both into account. Maybe it's more near-term, tariff back and forth, but longer-term, it's the jobs, it's how the employment picture works. That's really what's going to drive the bond market and ultimately what the Fed ends up doing over the course of this year.
Well, how much of the inflation expectations is doing the work of the Fed for it? If you're already seeing consumer confidence potentially drop, we'll get another data set later today at 2 p.m. UK time, you're already seeing inflation expectations and break-evens and tips price in that tariff threat. How much of that hawkishness is doing the Fed's work?
I think actually what's interesting is if you look at and listen to what Powell said, and I hate to bring up the T word of transitory, but he did.
Okay, he
did it. And yeah, he talked about the fact that they kind of took up their inflation expectations for this year, took down growth, didn't really adjust inflation over the next couple of years. So they do see it being as a one-off hit from a tariff standpoint. And I do think we're in a different situation than when we last spoke transitory during the pandemic, because actually growth slowing and inflation going up. Last time it was growth also positive as well. So I don't think they're as concerned if you look at sort of fixings on inflation over the next couple of years or so. Again, it's a near-term hit in the US, then coming back down again. For me, it's much more focused on growth, and I think you just need to listen to what the Fed said. They didn't talk anything about hikes. They talked about staying on hold with an easing bias depending on how the hard data plays out.
What about in terms of the European central banking story? We had a guest on yesterday who sees the ECB hiking in 2026. If you get a shock from tariffs and to inflation, what if central bank surprises again? How exposed are bondholders?
So I think what the ECB does next year is going to be really driven by what happens in Germany. Mm-hmm. And I think that's the big change that we've seen over the last few weeks, and that's probably shocked myself and most of the market is just how aggressive they seem to be. Does that play out? Do we actually start to see the fruits of the expenditure there, and do you start to see a pickup in European growth and inflation? That is what's going to drive the ECB. Again, I don't think it's so much tariffs. Actually, near term, you'd say the tariff concern would probably lead to the ECB cutting later this year. I think next year is going to be about what Germany does.
So do you buy French and German debt then?
I think if you had a sort of a list of which countries around the world you want to buy from a bond standpoint, you probably don't want to be focusing on European debt. You would prefer to be in the US, you'd prefer to be in the UK. Let's sort of say Germany more middle ground, and then JGBs I would probably prefer to be short.
Iain, can I go back to the tariff story a little, and just to get your sense of how you're approaching April 2nd and all that flows from it? Because it seems as if April 2nd has been built up in the market's mind to be such a big and important date, and we will get some clarity there. But the focus has been on whether we'll get clarity on US policy, but then there could be retaliation from all kinds of countries after this, and I wonder how much the market is and should be focused on that, because that could be quite material as to where this goes.
It could be, and I think that's what we've seen over the last few weeks or so, just that uncertainty element of what's going on in tariffs. We just don't know, and I think we all need to be honest with ourselves. And if that's the case, then you probably don't want to be owning quite as much risk as you did maybe earlier in the year when you felt that the US was going to be more pro-growth policies. It's evident that they seem to have taken a bit of a harder line. That remains to be seen exactly how much of a harder line, and some of the pullback over the weekend I think is interesting, that maybe it's not as certain that they're willing to allow the US or sentiment around the US to continue to slide. But I think that conviction level of kind of a re-acceleration of growth over the rest of this year, that's a challenge now, just given what we've seen so far.
And you were talking about how the Fed is not talking about hikes, they're talking about cuts, and maybe slightly more nuanced in their conversation about cuts. We heard from Bostic just overnight saying only one cut for him in 2025. But the market maybe doesn't put too much weight on this Fed commentary at the moment because the Fed, just like everybody else, is waiting to see what the White House is going to do.
Yeah, I think that's fair. I think what the market does take confidence from, though, is that you've got a Fed that does have an easing bias still. And we're probably going to bounce between the market pricing kind of one cut to maybe 3. We've been at both ends of those over the course of this year. I think to move ourselves out on either side of that, we're really going to have to see and look at the data. And you're completely right. The Fed's sort of sitting there waiting. We're all sitting there waiting to see exactly how this plays out. I will go back to what I said at the beginning. It's going to be the jobs market. It's going to be the employment picture that I think really drives, particularly kind of risk to the downside for rates cuts.
Isn't there a danger that lags, though? Isn't that sometimes quite a lagging indicator? And should we be looking at maybe the consumer in the US, such a big part of the US economy?
I think so, but I think if you go back to 2023, the trouble that we had was the head fake there, where the survey data, ultimately everyone was pricing in a recession, it was inevitable, and then it didn't happen, and actually the hard data continued to be resilient. So I think the Fed have sort of been wary about that, which means maybe you do need to start to see the hard data come through. But I completely agree with you, it could be lagged, which maybe means that if they do sit on their hands for a bit, then actually they need to go further in the end. So I'm still going to shout out that it is a good environment for owning fixed income, for the all-in yield you get, but also diversification if things do go wrong.
Well, Iain, you're talking about a very cautious approach, specifically from the United States, domestically and internationally, and yet you're short Europe and less optimistic, I should say, about Germany than we've heard from other guests on this program. My question to you here is, why less optimistic on Germany when, one, it seems to be the momentum trade of the moment, and two, it has the backstop, basically, of the German government? And I'm curious why that is a less juicy trade than the U.S. bond market.
So I think less optimistic on German bunds because you have got the backstop of the German government and the fiscal coming through. I think when we look at things like credit in Europe, we're actually still got high conviction there. We do think this is definitely a sort of regime change from what we've seen. We've effectively seen austerity out of Germany for the last couple of decades or so. That their debt to GDP hasn't gone up since before the financial crisis, when the US has ballooned above 100%. It's a huge difference. If the Germans do just pull some of that back, that should be really positive for the economy there. I think what would be interesting is, does it play out? How quickly do they get that going? I think there's sort of high conviction in that space. But ultimately, if you're going to get all this supply to the German bond market, I'd probably rather own government bonds in the rest of the world relative to Germany.
Iain, thank you very much. Thanks for joining us this morning. Iain Seeley, International CIO for Fixed Income at JPMorgan Asset Management. Coming up, we will bring you an exclusive conversation with the Qantas CEO, more on the airline's turnaround, travel demand, and the latest on aircraft deliveries. All that with Guy Johnson on the ground at that Airbus event. Coming up shortly, this is Bloomberg.
Welcome back to the opening trade. Let's get straight to Bloomberg's Guy Johnson, who is on the ground at the Airbus Summit in Toulouse with a guest. Guy.
Lizzy, good morning. Thank you very much indeed. Yep, welcome to Toulouse. A slightly chilly Toulouse, I have to say, this morning, which is not great news for my next guest, an Australian.
Hey, Guy, how are you?
I'm very well. Sorry, I
don't have a coat like yours.
Well, precisely. Very badly prepared on both of our parts. Vanessa, Hudson, Group CEO of Qantas. This is the first time I think we've spoken to you, 18 months into the job.
Yep.
What's going on? Give me a picture. Give me a status report of what is happening right now. Over the last few weeks, we've seen US airlines starting to downgrade their estimates. Give me the picture of Qantas.
So in the Qantas Group, we have both Premium Airline, which is the Qantas brand, flies both domestic and international, but we also have Jetstar, which is our low-cost carrier, which also flies domestic and international. And we're seeing demand remain strong. Strong domestically for both low cost and premium, but also strong outbound as well. So we're feeling really optimistic about the next 6 months and beyond. And the appetite that Australians have for travel has remained strong, and we've seen that now for a number of years. So.
Where is strong? Give me an idea of where you're seeing the strength at the moment. Because if America's rolling over a little bit, where is the strength elsewhere?
Really, we're seeing it in all our customer segments. So corporate travel is still recovering and it's growing. We're seeing it in premium leisure. We're seeing it in low cost, particularly. There's a cost of living pressures in Australia like there are in many countries around the world. And despite that, we're still seeing Australians want to take a holiday, whether that be domestically, because Jetstar flies pretty much to all of the leisure destinations domestically, but also internationally to all of the premium destinations that we have, but also into Southeast Asia. Bali is a massive holiday spot. Korea, Vietnam, Japan particularly. We're seeing so many Australians holidaying in Japan.
You don't go to China. Could that change?
Well, we fly to Hong Kong. And last year we suspended services into China because we just couldn't see the demand. But yes, absolutely. If we see the demand, we'll basically put our services back.
But a lot of capacity in that market at the moment.
There's a lot of capacity from China into Australia, and the demand just is not commensurate with that. So we see that, we redeployed those aircraft that were flying to China into Singapore and into India, and those services are doing really well.
In terms of what you see going forward, do you see any impact from tariffs? Every morning we seem to wake up and want to have a tariff conversation. Is that reaching down into Australia right now? Any impact in terms of consumer behaviour or what corporates are talking about? We appear to be heading towards a more fragmented world.
Well, right now, we're not seeing any impact. And if we did, we'd obviously let the market know. But we also have a very flexible fleet. And if demand patterns change, we will also move our fleet about. So that we do domestically, like that example with China, we would do that domestically as well. So we feel that we're really well set up with the right flexibility to be able to respond in any demand environment.
In terms of, you mentioned fleet there. You've got a lot of Airbus aircraft on order. You've just come down from Hamburg, where you saw your new A321 XLR, which is you're going to be getting a whole load of those. If you could bring forward some of those deliveries, do you have at the moment the business to take that? Would you want the fleet to be a little more advanced than maybe where it is right now?
Look, we were so excited to see the new aircraft yesterday with the Qantas colours on the tail, the A321 XLR. We've got A220s as well in the Qantas fleet. We've got 321 LRs and also 320 Neos in the Jetstar fleet. So, as you say, these aircraft are doing what we had hoped they would do. They're delivering better customer satisfaction, better outcomes for our people, lower fuel burn particularly, but they're also enabling us to grow. So the capability of these aircraft have enabled us to expand our network. So yes, of course, if we could get those aircraft sooner, we would. But we were with Airbus yesterday. We're really confident on the focus that they've got on their program.
One of the things that we're here to talk about at this summit is the sustainability story. Is it easier for an airline to buy new planes, like the ones you've just talked about, that reduce fuel burn, rather than maybe focusing on other solutions such as sustainable aviation fuel? What is the easiest route for the aviation industry, for Qantas, to get its footprint down?
Well, actually, aviation is a hard-to-abate industry, so it's not easy, and you've got to be investing and pushing on a number of fronts. So yes, investing in new technology is a helpful and step change in that most of the aircraft coming are about 20% more fuel efficient than the aircraft that they replace. But sustainable aviation fuel is also a really important part for aviation to reduce emissions. It reduces emissions by 80% versus fossil fuel, but it's not going to be easy. And so on this journey, you've got to bring a coalition along with you, whether it be government, whether it be the financial institutions, whether it be airports, and also a community of airlines that are like-minded as well. And so it's a journey. There are going to be points in that journey that we have to pivot and change as we go forward, but you have to have the ambition and the focus to start.
But Donald Trump is pushing America away from that green agenda. Does that give other governments, do you think, license to do the same? Could that be the fear here, that the impact he has as he backs America away from sustainability, that story is replicated by other governments? Yeah, he's doing it. We can maybe take a.
I hope that's not the case. I really do, because global aviation is a fundamental part of connecting the world, driving economies, and we need aviation to be more efficient and more sustainable. And so, as I said, as we go forward, we've got to have the right conversations with the right government, the right levels, and all be committed, because it's going to take time. You know, it's going to take many years, potentially a decade. And actually spending time with Airbus, they're also thinking about the next generation of aircraft that are coming as well. Yep. And these are big, long-term investments that you've just got to have patience and you've got to have commitment.
Heathrow, was there an effect? What did you see? How quickly could you rearrange what happened, and how quickly could you get back on track? Yeah, we had 2 flights coming in to Heathrow. We land pretty early in the morning, so we were one of the first airlines to divert. We diverted to Paris. And we were able to get our customers by road actually to Paris pretty quickly. We recovered within 24 hours. So. And what do you think the story is about Heathrow? What kind of feedback did you get from them? What was the message that you got about what happened? Well, I think always with these events, it's about making sure that you've got the right backup and the right redundancies, and hopefully in these events you learn and you actually make the right plans going forward to have that. So I'm fairly confident on the Lions beating the Australians at the rugby coming up. I'm less confident about the cricket. Is there an effect that you see at Qantas? Are you fully booked? Is everybody coming down to see you on Australia for that Lions tour? Well, we love competition, whether it be on the sporting field or whether it be, you know, more broadly in aviation. So we can't wait to welcome as many of UK down to watch the Lions and also the Ashes. So hopefully it's booking up really well. Nice to see you, Vanessa. Thank you very much indeed for stopping by to see us. Vanessa Hudson, the Group CEO of Qantas. And that's the first time that she has joined us here on Bloomberg Television, 18 months into her tenure. So finally being able to catch up. Guys, back to the studio. Thank you very much indeed.
Yes, where it is a bit warmer. Guy, thank you for enduring the cold in Toulouse. Thank you for that conversation. Guy Johnson on the ground there. Plenty about the aviation sector and sport, of course. Joining us now to talk about the markets. 10 minutes until we get to the start of the European trading day. Ven Ram, Bloomberg Markets Live cross-asset strategist, is with us. Ven, European futures look a little mixed now. US futures pretty flat. We have seen in recent sessions a bit of downward movement in the euro, and I wonder how you tie this into the latest ECB lines and our expectations around the ECB. What are you seeing in the euro?
Morning, Anna. I think that what we are seeing with the European stock futures is not wholly surprising to me. I thought that the bounce yesterday that we got on Wall Street was a bit too optimistic. I mean, if you look at the stock market, it's a voting machine in the short term and a weighing machine in the longer term. And I think that, investors are thinking, maybe the trade tariffs won't be as punitive as earlier thought, but we simply don't know what is going to be unveiled on April 2nd. So I think that, investors have got to wait and watch. What is also important to keep in mind is the Fed Atlanta GDP points to a contraction in the first quarter, and that is a real wall of worry for investors. If the economy is going to go into a tailspin, I think that you can't expect the markets to rebound as quickly as they have. So there is a word of caution there. On the ECB that you mentioned, Anna, I think that what is interesting to me is that we are two weeks away from what is going to be the quiet period for the ECB. 3 weeks away from the meeting, and yet we simply don't know what the ECB officials are thinking in terms of the next move. Excuse me. I think that the next move is likely to be a cut. I think there is no question about that, and I think the question is the uncertainty about the timing. One of it is brought about by tariffs, and we just discussed that. The other issue is the nominal neutral rate. The ECB's own researchers think that the nominal neutral rate is somewhere between 175 and 225. Excuse me. So I think that, as the ECB, with the next cut, they will be approaching the top end of the nominal neutral rate. So I think that they don't want to make a policy mistake here, and which is why they're taking the time to tell us what their thinking is. And I think that, as they approach closer to the neutral rate, I think they're going to be increasingly hesitant and not commit a policy mistake, which means that we just have to wait maybe for a week. We've got a bunch of ECB speakers today. Maybe we'll hear from them. And the question, though, is not whether they will cut again. They will cut again. But the question is whether they go in April or in June.
All right, Ven, 30 seconds here. Give us a floor, give us a ceiling on the U.S. 10-year.
I think that, the U.S. 10-year, I think that, there is a good risk-reward in terms of 10-year. In terms of the inflation, in terms of inflation, I think that, if inflation is going to bob around 280, a sweet spot for, and assuming an economic growth rate of 1.8%, which the Fed does, I think that 450 on the 10-year is going to be a good level to watch. And I think that, we are just in that sweet spot at this moment. So I think that is just perfectly priced.
Certainly quite the range that you've got there, Venram. We thank you so much. Bloomberg M Live Cross Asset Strategies. You get more up-to-date analysis from him and the team. MLIV Go is the function on your terminal. He was talking there about that big range, talking about it really depends on these economic growth messages as well. At the same time, 434 on the 10-year. That feels like its own story relative to what we're seeing here in Europe.
It's interesting that he cites a big range. We've had a few conversations with guests, haven't we, about the polarised nature of views in the markets right now and how people can have quite a lot of conviction over some quite polarised views. So we'll see where that takes us. It doesn't look as if we're expecting anything huge at the start of trade this morning, Lizzy. European futures, they are positive now, but not by much, and a little divided. The FTSE 100 might be a bit of a laggard. The CAC Carron up by 0.3%.
Yeah, FTSE futures just tipping into the green, but not much doing in the terms of what we're expecting out of this European session. Caution, as I say, very much the tone in these markets as they digest what is coming out of the White House in terms of the tariff message.
Yeah, Shell could be of interest, increasing distribution to shareholders, so that's one that we will keep an eye on. We'll also watch Kingfisher, guidance coming in a little bit lighter than estimated for that UK retailer, UK-based and listed retailer at least. Coming up, then we will bring you the opening trade. That's coming up in just minutes. Futures are pointing a little higher this morning. This is Bloomberg. Welcome back, 7:58 here in London. We are just a couple of minutes away then from the start of equity trading here in Europe. Yesterday in the United States, we saw strength coming through, certainly towards the end of the session. We saw a little bit of strength coming through on the S&P, picking up a two-day trend perhaps of strength in US stocks. In fact, if you go back to the middle of March, it seems as if we've got some strength, a bit of a rebound in US stocks. How does that translate into Europe? Well, earlier on this morning, it looked as if European futures were going to be a little negative, kind of in defiance or ignoring that trend over in the United States. But now we have European futures a little more positive. US futures, though, do point down, Kriti, and so we will watch to see how long this positivity lasts in the European session. But for the moment then, Kriti, we expect today's trade to sort of catch up with yesterday in the US.
Absolutely. A little bit of green on the screen, but not that major kind of gains that we were tending to see, at least in terms of the outperformance in the European equity market that we've seen recently. Where this morning, the outperformer is the French index, the CAC 40 higher by 0.3%. Compare that to the FTSE 100, which is flat at the moment, paring back some of its earlier gains, Lizzy.
Yeah, factor in the stock story. So you were watching the European automakers, car sales dropping in February. Trump also saying that he's going to announce tariffs on autos imports very shortly. Keep an eye on Shell out of London ahead of its Capital Markets Day, saying that it's going to raise shareholder distributions, reinforcing its position as the world's top trader of LNG. And Kingfisher, I've picked this out, the home improvement firm, results this morning, pre-tax profit forecast missing estimates, but they did announce a £300 million share buyback. So does that actually give them a boost, Anna?
Yes, indeed. So in terms of what we are trading around this morning, there are some new lines around tariffs, as Lizzy was just pointing out there, around autos, around some other sectors. So they are going to be firmly in focus. But how much of that is already in the price as we wait for April 2nd, waiting for the broader reciprocal tariffs? And the latest news flow around that has been that they could be a little lighter than expected. There could be breaks for some countries, in the words of President Trump. So where does that leave European equity markets? Well, we're waiting for most of them to open up this morning. So we are just starting to see some action then on the London market, up by 0.2%. The IBEX over in Spain is up by 0.4%. So we'll wait for a little bit more of the detail on these European equity markets to see where we end up. As I say, US futures are a little bit sluggish, so we are seeing a little bit of negativity sort of looming on the horizon. We're waiting for some data out from here in Europe. We'll get that IFO number a little bit later on. So current and future expectations for German business, that could be an interesting driver of trade a little bit later. We're filling in some blanks. The CAC Carron's up by 0.3%. 0.3%. The Xetra DAX up by 0.3%. Waiting for that German data, waiting for further details around the tariff landscape and how that's going to stick then, Kriti, to various sectors. What stands out to you this morning?
Yeah, absolutely. And the kicking off in terms of the biggest movers to the upside from an index contribution perspective, it's all about the oil space, although it is coming among some pretty broad gains. You can see it on the screen there, a pretty broad rally across the board. Energy, to me, really stands out. A lot of that's going to be driven by the numbers coming out of Shell. We'll dive into that in just a moment as well. Total, though, is coming up second. You're also seeing some of the luxury names as well outperform, and that has been a consistent theme when it comes to the outperformance of the French index in the last couple of days as well. And that's just one side. The downside, though, I'm seeing a lot of defense names. I'm seeing a lot of auto names. So it looks like Germany seems to be on the back foot.
Right. The broader sector story, though, is interesting because we've got autos and parts as the best performing sector, and no doubt there's some interesting detail underneath the hood. But it's interesting that on a day where we've got a sort of negative story around autos, European car sales, but maybe it's the fact that Tesla is so weak, and that maybe is creating some space for other European automakers to step forward and at least cushion the downside there. That could be an interesting line of inquiry to probe, and I know we've got Craig Trudell coming up on the programme a little bit later on to talk about that. But there's so much news flow, sort of cross currents that could be affecting the auto sector. It's hard to pin it down. We've had these lines from President Trump saying in the coming days we might get further tariffs on autos, but that doesn't seem to be weighing too much.
Yeah, so auto is the best performing sector, higher 0.9%. Every sector in the green, bar one, which is industrial goods and services, which of course has had lots of positive days because of defence boosts recently. But if we just dive into the auto sector, you've got Volkswagen up more than 1%, so are BMW and Renault's up 0.9%. We have mentioned Shell because of this announcement of raising its shareholder distributions to 40 for 50% of cash flow from operations. That's up from 30 to 40% previously. And indeed, those shares are up 1.2% this morning. We'd also mentioned Kingfisher. We wait for those shares to open. But as you say, more broadly, we had expected the FTSE 100 to underperform compared to the rest of Europe, and it's actually pretty much in line with the rest of the European indices at this point. Let's dive into some analysis of this now, shall we? Gerry Fowler, Head of European Equity Strategy and Global Derivative Strategy over at UBS, joins us around the table. Morning to you, Gerry. Are you betting that the US equity pullback is kind of done, that it's bottomed? Because, of course, that has been very much impacting the story in the rest of the world.
It really depends on policy uncertainty, because to some extent what precipitated this was just marginal weakness in earnings expectations through Q1, particularly for the Mag 7 companies and broadly the rest of the market as well. But the scale of retracement we've seen is much more than that. And that's partly because valuations reflected a huge amount of growth premium that is being called into question with these downgrades. So the valuation is derated a lot. But also the policy uncertainty of 25% tariffs on, 25% tariffs off, 25% tariffs on, it's just too much. So obviously that just raises risk premium across the board. So at the moment, what we're seeing is that risk premium is coming down because Trump is talking in a more predictable way about the rollout of tariffs, potentially even scaling back the impact of them, at least initially, although there may still be, a longer-term endgame in place. So while tariff implementation is likely impactful for stocks, the predictability of the implementation that we may be seeing come through next week might actually mean that the market gets a bit of a reprieve from the uncertainty. Okay. So at least a tactical rally, but we do think for a few good reasons it could be a sell the rally type market.
Yeah, because we've been debating how much you should listen to the optimism around headlines around, for example, that there might be a more measured approach when it comes to tariffs. When we look at the European side of this then, are you betting that the growth from the fiscal boost outweighs the tariff impact?
Yeah, it almost certainly does. So the tariff impact, we think, is around about 0.2% of GDP in Europe for about a 10% universal global tariff. So it's not particularly meaningful. It's all in 2025. It's all in the export sector. So it means it's reasonably stock-specific to the companies that are exporting. But we're talking about upgrading GDP forecasts for 26 and 27 by 0.6 and 0.7%. So it's a bigger deal over the longer term that we're doing the stimulus in infrastructure, in defence spending. It will probably percolate across to confidence for the consumer as well. So it should matter more that Europe might have 2% real GDP growth next year, 4% nominal growth next year, and that might be the same or even higher than the US, depending on how fiscal contraction occurs there.
OK, so that's interesting, Gerry. So you think if you look at the sort of head-to-head battle between the negatives for Europe of tariffs and the positives of fiscal stimulus, you think fiscal stimulus is more significant because of the way it will spill out around the rest of the economy then?
Yes, from a GDP effect as well as a confidence effect, because the tariff impact is reasonably narrow and specific to certain companies. I mean, even a 10 to 15% tariff we think might only shave 5% off European earnings. It's not a particularly big deal in the context of what we think will be an earnings acceleration into 2026 and 2027 on more government spending and greater consumer confidence.
Does that sound like an ECB that continues to cut rates then, if the tariff threat is sort of moderated to a large degree?
It depends how quickly we come up against supply constraints, because at least in things like the manufacturing sector, there's spare capacity. So we shouldn't really be seeing inflationary pressure in certain parts of the market for some time while we absorb that spare capacity. So we'll see. We'll see. At the moment, there doesn't appear to be significant supply shortages in any factor of production. So we'll be OK for a while.
We see a lot of outperformance in the periphery, or have been, at least prior to the German announcement when it comes to fiscal spend. We've seen that in the bond market. There's a narrative right now that perhaps the equity market in the periphery, the Spain, the Italy, the Greece, will actually benefit because of that inward-looking domestic exposure and less international exposure. Is there merit to that argument?
Yeah, possibly. I mean, countries in Europe are really differentiated more by their sector differentiation than they are their regional differentiation. So in Spain and Italy, for example, you've got larger concentration of financials, which tend to do quite well when you've got a cyclical acceleration, rising growth and inflation expectations. They've also got utilities that we think are cheap and growing. So to some extent, their sector mix has been favourable anyway. But they also are likely to be the economies that, doing quite well, don't really need lower rates. You know, they're the ones that are already sort of to some extent booming. And so actually it just sort of accelerates their potential growth. So we have no problem with some of these more cyclically and value-oriented markets continuing to outperform the more defensive markets, particularly things like the UK.
That sounds a lot like the bond market and the equity market are beating to two different drum beats. Is that a fair analysis?
Well, not necessarily. So the bond market is selling off, but it's not selling off for sort of the usual European reasons of debt sustainability and concern about, whether governments can afford this, because Germany can afford it, and to some extent it's free fiscal stimulus for the rest of Europe because it won't all be spent in Germany. So bond yields are rising because growth expectations are rising. The real yield is up because this is a more positive growth-oriented acceleration in Europe coming through 2026 and 2027. It's the first time we've seen it in a long while. First time Europe has had esprit de corps that really, allows confidence to grow in Europe.
But Gerry, you mentioned the UK. Does the kind of allure of the DAX diminish the appeal of the FTSE? I was talking to someone yesterday ahead of the spring statement from the Chancellor Rachel Reeves, saying that it's just government after government announcing managed decline when it comes to the UK economy.
Well, perhaps. I mean, what the UK is trying to do is keep its budget deficit and debt burden in check. But that will be alleviated substantially by growth, which has been pretty anemic. So long as growth can be generated, whether that's through less regulation, whether it's through the stimulus and encouragement of home building activity, which is particularly important for value add. If a dollar spent on home building ends up percolating through the economy more than 4 times, whereas a dollar spent on any service tends to only percolate through the economy twice. So a lot of the activity in the UK should end up producing more growth in time. And with that, there should be more flexibility for the UK government to be a bit less restrained.
Yeah, interesting you talk about free fiscal stimulus for the rest of Europe coming through from Germany, which I get when you talk about where those GDP, where that money gets spent.
Yeah.
And some of it may be on infrastructure companies and defence companies
Yep.
around Europe. But of course, in the short term, it's pushed up yields, and that's an issue for headroom. So I don't know, it's interesting to think of it as a gift. It doesn't feel like a gift, maybe, if you're Rachel Reeves and you're trying to work on your spring statement.
Well, it depends on the growth. So if the stimulus leads to higher growth, then the government can therefore afford the higher yields. So long as it's growth expectations rising with yields, then it should be okay. Because what we're really keeping an eye on is whether those fiscal deficits of countries are above or below the nominal GDP growth in the economy. And if we look at the US, for example, we've now got the largest non-recessionary level of premium of deficit, which is about 7% in the US, to nominal growth, which is about 5%. So the US is growing its debt burden pretty rapidly at this point. That's the case in some countries, like France, not growing very strongly, but does have a 7% deficit. But it's less obvious in other countries that have, lower deficits that actually are roughly in line with or potentially even below the pace at which the economy is likely to grow in the coming years.
There has been a question as well about just record amounts of trillions of cash sitting on the sidelines that hasn't necessarily been deployed to the public markets just yet, or even if they are being deployed, but they're being done through hedging strategies or derivatives, et cetera. You're the perfect guy to ask about this. Are the $6 trillion that have been kind of wrapped up in money market funds being deployed to the public markets?
Well, cash is cash, so someone will always own it, but it is to some extent a reflection that there is perhaps still a lot of COVID-related cash that's floating around the system. So liquidity doesn't seem particularly tight in most markets at the moment, but rather than the $6 trillion of cash, which ultimately is just fungible with somebody else's view on whether they want to hold cash, I'd point to the nearly $17 trillion that foreigners own of the US market. It's a huge amount. It's the highest share of the US market that we've ever seen. We know why, because of US exceptionalism, foreign investors wanting to buy into that story. If that even gets called into question a little bit, let's say foreign investors decide they want 5% less US equities. That's $1 trillion of selling of US equities. It's a huge amount. You try and take $1 trillion out of US equities, it's going to have an impact, but probably only the space of months and quarters because it's a big liquid market. You try and put $1 trillion into the rest of the world equity market, that's a really big deal. So I think rather than sort of thinking about the cash on the sidelines, I'd think about where investors are invested and whether the news flow that we've seen, both positive in Europe and potentially more uncertain in the US, particularly as they move towards fiscal contraction, might drive a rotation that, even if it marginally reduces US equity ownership, could be a really significant liquidity provision to the rest of the world.
On that trillion then, Gerry, how far through that are we already? Nowhere.
Well, considering it probably only started moving a month ago, I think, you couldn't have moved more than tens or maybe the low hundreds. Very low amount. It's a huge amount of money to try and move. It's an estimate of what could move. It's only a 5% reallocation. But considering how overinvested we know investors have been in the US, it seems entirely plausible. So it does, to me, just say that while there is this uncertainty, the likelihood of slowdown and fiscal contraction in the US, it is a sell the rallies market because of that weakening growth driver and the over-allocation to US assets. And it's a buy the dip market in any other economy that looks like it might be able to generate some growth.
All right, Gerry Fowler, head of European equity strategy and global derivative strategy at UBS, joining us around the table this morning. I'm going to do my best Guy Johnson impression and take a look at the core six. Of course, the heavyweights that move a good chunk of this market. Yesterday, the story was all about tech about 24 hours ago. Today, you're seeing a rebound in some of the other major movers. So, for example, LVMH seems to be driving the market higher and the French index higher as well, higher by 1.4%. Novo Nordisk also recovering from yesterday. Remember, SAP had overtaken Novo Nordisk in yesterday's session as the largest company in Europe, higher by 0.3% for that stock this morning, for Novo, not for SAP. But you are seeing a reversal from the tech space. ASML, I think, is a great example, down about 0.1%. And even Schneider Electric, which was one of the outperformers yesterday, reversing, paring some of those gains down about 1.4%. So that is your core six. Let's check some of the other individual stocks on the move with Joe Easton. Joe.
So one stock not having a good day at all, Kriti, is Kingfisher here in London. Now remember, this is the B&Q owner, the retail DIY company, and it is dropping at the most since November today. So we're down almost 12% for Kingfisher now. Now, actually, most of the weakness seems to be in France. The French market is where the weakness is. The UK actually holding up pretty strong in terms of all of us doing our DIY. The like-for-like sales look pretty stable in the UK, but it's France where we are seeing a lot of weakness, and that is the reason we're seeing the drop in that stock today. Then I'm also looking at truck makers. Barclays out with a note today, downgrading all three of the big truck makers. So they downgrade their ratings on Volvo, Daimler Truck and Traton. And this is linked to not only US tariffs, but also a few weeks ago, we saw news that the US is rolling back some of the regulations on the emissions of trucks. And those emission regulations were seen as a reason for companies to buy new vehicles. And now that won't happen, according to Barclays. They don't think that this big order increase will come through, and therefore they're downgrading those. So actually, as you guys were mentioning on the show earlier, most of the auto sector holding up pretty steady today, but the truck makers really weak following that news, that note from Barclays today. Then in terms of energy, Shell looking pretty strong, increasing their returns, potentially around half of their spare cash could go back to shareholders, and continuing their margins, their margin progressions looking pretty strong as well. The one negative on that report, on that CMD update, according to UBS, was there was no new quarterly dividend increase, according to UBS, and that was a negative. But for the moment, it's holding up pretty steady and continuing the outperformance that we've seen against its big rival BP here in London. And then finally, the other energy stock going the other way was Neste over in Helsinki. This is a downgrade this morning at UBS. This is a company they say is actually seeing weaker than expected margins. So they cut their rating. They were buyers. They move it down to neutral. And actually, that's been one of the worst performing energy stocks in the past year, partly because of their renewables business that is struggling. Neste weak today. Shell doing pretty well in the energy sector in terms of the movers this morning.
Yeah, absolutely. Shell doing OK. Joe, thank you very much. Joe Easton from our equities team. Now, because we are, Kriti, a little closer to the United States this week and the past 2 weeks, we have US pre-market open, don't we? What caught your eye?
Yeah, the most wonderful time of the year, I think, when it comes to the U.S. pre-market. Let's talk about Tesla here, because, of course, we did have those drops in European sales numbers, specifically in Tesla numbers as well. And yet the stock is higher. And I think it's worth noting that the shares are higher by about 0.5%, 0.5%, $279 a share. But this is a stock that has been beaten down quite a bit. So there is an element of buy the dip here, especially when it comes to the auto sector. And you're seeing that sentiment also echoed in a lot of the European automakers as well. That's going to be one name to watch, including how it's moving with some of the other tech names. The other one I've got my eye on is Boeing shares. Shares are down about 0.4% in the pre-market. Now, it's worth noting that the Wall Street Journal has reported that they are seeking to withdraw the guilty plea deal in the 737 MAX case. Now, this is a really big deal because it does actually intervene and have an effect on how quickly Boeing can recoup the losses and actually come back to the production story. The guilty plea was part of that agreement with the DOJ. It looks like they are now reported to be, by the Wall Street Journal, I should say, looking for more lenient treatment. The shares not responding well to that. And I'm going to say Oracle also wrapped up in some legal battles here, this time around Paramount's sale to Skydance for about $8 billion. Now, remember, the CEO of Skydance is David Ellison, the son of Larry Ellison, who is the founder and CEO of Oracle as well. Those shares down about 0.5%. The legal battles in both Boeing and Oracle very much having an effect on the markets this morning.
Coming up on the programme then, Kriti was just talking there about what's happening with the Tesla share price. We've been tracking global autos. European autos were a little stronger this morning out of the gates, fading those gains a little. The global auto industry bracing, of course, for US tariffs after Donald Trump says he will proceed with levies on vehicle imports in coming days. So it sounds as if that could come before April 2nd. We'll discuss that next. This is Bloomberg. Welcome back to the opening trade. Now, the Airbus CEO, Guillaume Faury, says any potential tariffs between the US and Europe could be more problematic for the plane maker's rival, Boeing. Airbus's main factories are globally more spread out than Boeing's, he says, which only assembles its aircraft in the United States. In an exclusive interview with Guy Johnson, Faury added that he's encouraged there hasn't yet been talk of aviation-related tariffs.
We had tariffs on aircraft 4 to 5 years ago between the US and Europe, and has been a lose-lose. Therefore, we had a ceasefire in 2021, and I think this experience has been interesting in showing that for a sort of North Atlantic ecosystem, both sides of the Atlantic, there's only lose-lose in putting tariffs. We have not heard about tariffs on aviation at the moment, on aerospace. I think that's a good sign. There's nothing more, I would say, really to prepare than to communicate, to exchange, to explain. We have a lot of infrastructure and manufacturing capabilities, final assembly line in the US. We are procuring from the US, we're selling to the US, and the US manufacturers are doing the same with Europe. So tariffs in the middle of the Atlantic would really be a big burden for both sides, and maybe that would be even tougher for the US manufacturers.
Have you been putting extra resources into the Alabama plant? Have you been stockpiling? There's no kind of preparations or anything that you have been taking on thus far in order to get ready for something that could be coming?
No, we keep doing what we've been doing so far, relying on Alabama, indeed. That's a plant where we have 3 final assembly lines. One is not yet delivering planes, but the 2 others are. So we are procuring from everywhere around the world, assembling there in the US with US jobs, 2 US airlines as well. So I think we are key to the US ecosystem, to the aviation ecosystem, and we think that plays a big role in how tariffs are targeted.
Okay, final quick question. You sit on actually the Business Council in America. You speak to CEOs there. What message did you take to them from Europe? What is the message that should be coming to A, US business, and B, the US administration?
Well, at the moment, I think there's a lot of questioning of where all this is going, what it will mean for which industry. So it's a bit on wait-and-see mode to understand better for how long tariffs could come, who will be impacted, how to respond to the tariffs, if any. As I told you, we are not directly targeted with tariffs at the moment, but indeed there is a lot of questioning and to understand better what is changing and how to adapt.
The Airbus CEO Guillaume Faury speaking exclusively to Guy Johnson. That's the aviation sector sorted. Let's pivot to auto, shall we, Kriti?
Let's do it. Donald Trump says he will proceed with long-threatened tariffs on auto imports in the coming days. The U.S. president also indicating that some nations may receive breaks from next week's, quote, reciprocal levies. Joining us now is Bloomberg's Craig Tudell, who leads our global autos coverage and has the fun job of tracking everything Donald Trump says on that front. So what do we know, and how happy are Americans about this?
I think the short answer is we don't know what we know at this point. There are a lot of sort of unknown unknowns because one day Trump is sort of leaning that these are coming. The next day there's sort of indications, sort of smoke signals coming from the White House that maybe sector tariffs will be avoided. I will say that I'm not necessarily shocked to see that Trump would sort of keep leaning back toward doing this, in the sense that when he talks about trade and when he talks about tariffs being, the most beautiful word, it's almost, like clockwork. He turns to cars almost right away consistently. This is something that, is sort of stuck in his mind as the way in which the U.S. has been, in his mind, treated poorly, treated unfairly, and he wants to level that playing field and deliver manufacturing jobs.
Craig, I'll admit I was a little surprised to see the car makers doing so well this morning. The likes of BMW up more than 1.3% this morning. Is that schadenfreude about the Tesla numbers? Just disappointing sales here in Europe. A 40% drop, I think it was, for February. Or is it to do with tariffs? What is this?
It's hard to say. I mean, I do think that it is sort of abysmal, the numbers from Tesla to start the year. The ease with which the rest of the industry is having selling electric vehicles. It's not just that Tesla was down 40%. It's that the rest of the industry, even despite that big player being down so much, was up more than 30%. I think the overall sales for the industry were a little bit soft, but I do think that when you look at sort of how this market is changing a bit, it's becoming much more competitive, and it's no longer the case that Tesla's up here and everyone else is way back behind.
And talking about big sellers of electric vehicles takes us to BYD. They had some numbers out. This is the biggest seller then in the world's biggest market. So this is certainly one that we need to keep on our radar, but still not a huge presence in Europe and definitely not the United States.
No, that's absolutely the case. I think the way that BYD has evolved just the last few years, it really is sort of breathtaking how quickly they've grown. For them to actually have more revenue last year than Tesla did, to do that not just with fully electric vehicles, but with plug-in hybrids as fully electric vehicle growth slows.
OK, Bloomberg's Craig Tudell across the bajillion car stories out this morning. We thank you. And coming up on the programme, Ukraine's energy infrastructure hangs in the balance after the US-Russia talks. We're going to talk to the UN's nuclear watchdog chief next. This is Bloomberg.
This is the opening trader at 30 minutes into today's session. Seeing green on the screen across the board. Euro stocks 600, I think I should say, higher by 0.3%. But the DAX is now unchanged. A real reversal in terms of outperformance that we saw over in Germany, now replaced perhaps by the French index. LVMH is a big part of that story. CAC 40 higher by 0.4%. Anna.
Let's pivot, Kriti, to some of the geopolitical conversations that are taking place globally. US and Russian officials have concluded talks in Saudi Arabia, with a statement expected shortly. It follows an equivalent meeting between the US and Ukraine on Sunday, which placed renewed focus on the country's energy infrastructure. The Trump administration's push to contain the war in Ukraine runs parallel to a ratcheting up of pressure on Iran to strike a new nuclear deal. Lots to discuss then with Rafael Grossi, the Director General at the International Atomic Energy Energy Agency, the IAEA. And it is a pleasure, Rafael, to have you on the programme. Thank you very much for joining us. So your organisation to promote safe, secure, peaceful use of nuclear energy. With that brief in mind, Rafael, what is at stake when you watch these conversations about Ukraine between the US and Russia?
Well, pleasure to see you again. Let me say that of course, my first reaction would be one of relief, because we see that for the first time there is a possibility that with combat ceasing, stopping the dangers that have been hanging over the biggest nuclear power plant in Europe and one of the biggest in the world would recede. I can tell you that in September 2022, I personally led a mission by the IAEA, and we set up a presence there, a permanent presence at the plant. And over the past 2 years and a half, 2 years and 7 months, more precisely, we have been witnessing many dramatic moments, some shelling, drones, blackouts, several, more recently a cooling tower of the plant up in flames. So a number of occasions where we were very, very close to a nuclear accident with serious radiological consequences. So for the first time now, we see that there is a discussion, at least, about the possibility of this sort of ceasefire, which could bring some relief and a possibility, hopefully, as everybody else is waiting for something bigger, wider in scope. So we are following that and perhaps ready to play our role in this.
OK, and yes, as you point out, the IAEA has had a team on the ground working in very challenging conditions at Zaporizhzhia, at that nuclear facility, Rafael. How lacking is the maintenance there? How far from able are you to assure the international community that everything is exactly as it should be at Zaporizhzhia?
I would make a distinction there, Anna. One thing is the danger, which is, of course, concomitant with having such a big nuclear power plant, 6 reactors, lots of nuclear material inside, in a combat zone, with the distinct possibility that you could have a direct hit or something of the sort. And then you are mentioning the issue of maintenance. Maintenance, we have to bear in mind that the plant is under Russian control. As we know, this is, of course, a disputed fact, and, of course, Ukraine is contesting this, but the reality is that this plant is under Russian control. The IAEA is there. There is no imminent danger in terms of the maintenance, internal maintenance of the plant. So the preoccupying factor, the concerning factor, is the fact that this is in the middle of a war zone. And the other thing that I think and I hope once there is some understanding, some agreement at the political table, is how to do the necessary checks that are obviously necessary. Don't forget, ladies, that this facility, which is a huge one, has been in what we call in the jargon shutdown, in cold shutdown we call it. So before you restart such a huge facility that has been operating at a very, very low level, there are many things. Imagine a car or something, any sort of machine that you haven't been using for a long time, winter, summer, etc. So you have to do a lot of evaluations and assessments to be sure that there is not going to be a problem. So that is part, I think, of the next steps. But when you ask me, Anna, about the imminent thing, I would say is more the fact that we are continuing in a place where people are shooting at each other.
Yeah. Rafael, Lizzy here. Good morning and thank you for joining us. Let me ask you about this proposal from the French President Emmanuel Macron. He's been pushing for France's nuclear weapons to be used as a regional deterrent. I wonder, would a nuclear umbrella actually work?
Well, I must say that here again we have to make a number of distinctions. Because what has been said by President Macron and others, does not apply directly to the resolution of this conflict. They are more, talking about the new security, if you want, strategic configuration and how to guarantee it. Another point to be reminded of is that under the current agreements that Europe and the Atlantic Alliance do have, nuclear weapons are deployed in Europe. Even American weapons are deployed in Europe. So we are not seeing something completely new. What we are seeing is a reconfiguration of this, and perhaps it's not my thing to be talking about what at the political level President Macron or others may be deciding. This is a political thing, but I'm just telling you from a technical point of view that the presence of nuclear weapons there, and also be reminded of from the Russian Federation, nuclear weapons deployed in Belarus. So it's been part of that. In general terms, of course.
Yeah, but I understand, Rafael, that this is.
Yes.
I understand it's strategic, but of course we have to be asking the question about, for example, how exposed the UK would be if relations with the US broke down, if cooperation on nuclear weapons broke down. We've just been reporting about this leak, the top US officials privately discussing how Europe is pathetic. Is this a safe alliance to rely on?
Well, that is part of the political conversation, of course, and the political dialogue, which is not something the IAEA is following as part of its mission. What I would say is that we need, of course, circumspection when it comes to talk about nuclear weapons. Circumspection and restraint is what is needed. At this moment, we are seeing the possibility after almost 3 years of a bloody war in Europe, the possibility of a ceasefire, the possibility of some stability being brought to the table. So quite clearly, from the perspective of an international organization dealing with non-proliferation and nuclear weapons, what we are calling is, of course, we're not telling, I should not be telling Prime Minister Starmer or President Macron or whomever what to do. What we are saying is circumspection, restraint, and of course, nuclear weapons, we should never forget, are the ultimate instrument of destruction. So there should be very long and deep thought about that.
Well, Rafael, speaking of that long and deep thought, let's talk about another part of the world, and that is Iran, of course. We know we're seeing some very hawkish rhetoric out of the Trump administration. The Trump administration has favored a complete stop to Iranian enrichment. How realistic is that possibility?
Well, on Iran, again, I would say we are in a new chapter, not for the IAEA. We have been dealing with Iran for the last 20 years or more. But we are at a very, I would say, important juncture in the sense that we know that there has been an outreach from President Trump, a letter being sent to the spiritual leader of Iran. I have been in Tehran last November, talking to President Pezeshkian, talking to the foreign minister, and I might be returning soon. I think it is clear that we need to have some form of understanding. Of course, with Iran, an understanding that would preclude completely the possibility of Iran getting a nuclear weapon. Because obviously in the current circumstances, against the backdrop of a Middle East that is at a very volatile phase, the addition of to the pot of nuclear weapons would be catastrophic. So I think we are all clear on the need to avoid this situation. How you get it, how you get to that point, this is the key. And there was an agreement, as you know, the famous JCPOA, which had been signed in 2015 with great pomp and circumstance, that does not exist anymore. You don't have that anymore. It exists only by name. So
well, Rafael, let me
measure of control.
Let me
at the moment.
Understood. Let me talk to you about your role and the IAEA's role in that. There's been a probe specifically for Iran looking into uranium particles detected at undeclared locations. So in terms of active measures of that monitoring, walk us through if you're any closer to resolving that probe and what you've learned from your discussions in that area.
Well, we are not, I must admit, we are not where we would like to be. We, as you rightly said, we detected, discovered traces of uranium at places that were not supposed to be or to having hosted any nuclear activity. So we have been asking our Iranian counterparts, where is this material? Where is the equipment that was evidently used to deal with this material? So we haven't had, I must say, answers or satisfying answers, rather, to these questions. The process continues. As I told you, I was in Iran. I intend to continue. But now these things come together. They gel. Because you have, on the one hand, these unresolved questions from the past, and then, at the same time, the possibility of having some viable agreement for the future. But as you know, common sense dictates, you cannot build on shaky basis. You need to have the truth first to see where you go and you move forward. And we are going to be working with that, with the United States, with Iran, with our European friends. We must do it. It's absolutely necessary.
Well, Rafael, we look forward to that update on that probe. A final question to you on maybe how the IAEA is approaching not necessarily the geopolitical hotspots of the world, but specifically the build-out of nuclear power in Europe. There's a lot of conversation right now among the major tech players in the world that for an AI data grid build-out, nuclear power is an answer to the prayers of the energy crisis, sustainability. What evidence are you seeing of that as nuclear as an answer to that AI build-out?
You know, we are not peddlers or lobbyists for nuclear energy. We promote the peaceful uses of nuclear energy, and quite clearly nuclear energy is indispensable as part of the right answer to the current energy and economic situation. I like to say that what we are seeing is a return to realism when it comes to nuclear. Nuclear has a role to play, has been playing an important role. In G7 economies is indispensable, is very big. And now, interestingly, and I think you have mentioned this, of course, from the perspective of Bloomberg, I find it absolutely logical. We see in the economy, we see sectors like AI, IT, that require lots of energy, CO2-free energy, dispatchable energy, which is there 24/7. In a very, I would say, modular way. And of course, people have been looking at alternatives, and small modular reactors and nuclear reactors are part of that. And we have seen Google, Meta, and many other companies signing contracts with nuclear providers in order to have these small modular reactors. So we see the evidence there. For rollout, if you ask me, perhaps it will be within the next 5 or 6 years, but quite clearly the trend is there.
All right, Rafael Grossi, Director General of the International Atomic Energy Agency, covering a range of topics for us this morning. We thank you so much for your time. Coming up on the program, HSBC planning to double down on investment banking operations in Asia and the Middle East. More from our exclusive interview with the CEO next. This is Bloomberg.
Welcome back to the opening trade. Now, the HSBC CEO plans to double down on investment banking operations in Asia and the Middle East after exiting key businesses in Europe and the US. The CEO, George Elhedery, spoke exclusively to Bloomberg's David Ingles at the bank's Global Investment Summit in Hong Kong about that shift.
So what we announced is we will be incurring about $1.8 billion of cost, essentially severance costs.
Okay.
that the saving, most of the decisioning for that will take place this year. Most of it will take place in the first half of the year. That the benefits will start materializing this year, where the $300 million benefit will come this year. That the benefits will materialize in full by the end of full year 2026. So the full year 2027 will benefit from the full $1.5 billion saves that we're targeting. What we also committed that these will be permanent saves going forward, and that we're taking these saves straight to the bottom line. So it's a payback period of effectively roughly 2 years, but it's a permanent benefit that we will achieve.
And then the other component there is a further $1.5 billion, which I was looking at your earnings statement, and it was page 11 or 12, I think, of the strategic review. And the way you phrase it there is a reallocation of those costs into growth businesses. So I think it's a two-part question I have is, if you're reallocating costs, is that a net savings? Is $1.5 billion net savings? And what exactly are you looking at doing? Because there's not a lot of detail on that.
Yeah. So the organizational simplification benefits, which are efficiency saves, not impacting revenue in any material shape, $1.5 billion, those will be taken to the bottom line. That's the first $1.5 billion.
Yes.
Now, additionally to that, we're also looking at the what we do and recognize that there are further focus that we can achieve in our business, where we will be taking $1.5 billion from activities that we are currently doing that are either non-strategic or non-returning, and we will reallocate these $1.5 billion as we materialize the saves. We reallocate them back into areas where we have competitive strength, where our customers expect us and need us to be, where we can generate good returns, and where we have greatest opportunities to grow. This second $1.5 billion, the revenue we will lose against it because we will be stopping activities.
Those units, those assets, yeah.
Those assets. We expect to be able to generate better quality revenue instead, because they're more strategic or higher returning.
And have you told your team, have you given a timeline for that second tranche of?
Yeah, we expect to do it in the medium term, but there are a number of these initiatives which we already communicated to the market. For instance, about $300 million of this $1.5 billion will be delivered through our decisions around investment banking, in particular M&A and ECM, in Europe and in Americas, where we're basically scaling down this activity. And others will come from other inorganic activities, such as the sale of our German private bank business, the sale of our French insurance business, Bahrain retail business, etc.
The HSBC CEO, George Elhedery, there speaking exclusively to Bloomberg's David Inglis. Let's get analysis now of that HSBC restructuring update and its business outlook with Bloomberg's Jenny Serene. Jenny, Elhedery seeming pretty pleased with himself by the sounds of things on that restructuring, but what's left on the horizon in terms of the cost cuts?
Yeah. So I think it was super interesting to kind of hear him lay it out, because they've basically identified about $3 billion worth of costs that they can get rid of in this business. Now, $1.5 billion of that is just costs that will go away. They'll allow that to drop to the bottom line. Shareholders should be pretty happy about that. The other $1.5 billion is areas that they're going to reinvest in. So he gave the example of investment banking. So that's where, they've decided we're going to get out of things like doing IPOs or advising on M&A in places like Europe and the US, where we've just never been able to really make a mark. And we're going to reinvest that in areas like Asia and the Middle East, where we think we have real opportunity to grow and a franchise that can actually get scale. So I think you see him kind of trying to hit both marks, both pleasing shareholders, letting some of that drop to the bottom line, while also trying to have an eye on the future and making sure that they're kind of growing into that. But it'll be interesting to see if he can pull it off, because it's certainly a tightrope that he's got himself on.
Walk us through then kind of the growth that's meant to be coming from Asia and the Middle East specifically. Why dive in when they so actively dove out?
Yeah, no, I think it's a really interesting question, because, you see them pulling back on places like Europe and the Americas at a time where we expect deal volumes in those two places to really surge. And so you see them kind of shifting their focus to places like Asia and the Middle East, which, to be fair, are fast growing. But it'll be interesting to see if this is a good bet in the end. Are they pulling out at the exact wrong time, or are they calling it quits on a business where they've just never been able to make traction? I think that's the kind of key question that investors are going to to be putting to the CEO, especially in these next months ahead.
And Jenny, let's talk jobs. And have we seen the people who, because these are big changes, so have we seen the people in the regions where they're pulling back that need to leave the business? Have we seen that happen already, or is that still to come?
I think that's still to come. So when he talked just now about the $300 million that they see kind of hitting the bottom line this year, that was specifically around a lot of the investment banking moves that they're making. So what they've said is we're going to keep doing the deals and the IPOs that we've already agreed to do, but we're not going to sign any new ones. And so as these deals slowly make their way to completion, the employees that are working on those projects will be going away. And so he talked about that in the interview too. It was super interesting to kind of hear him talk about the human side of these changes. And so it's kind of an important reminder that these CEOs, they make all these big strategic decisions, and then, you know, as they have to carry them out, it's tough work. So absolutely, I think that'll be another kind of big shoe to drop with all these changes, is actually exiting some of these employees.
Jenny, thank you very much. Jenny Serrain there, Bloomberg's Europe and Middle East finance editor. Now, in the next hour, the IFO Institute president, Clemens Foist, will be joining The Pulse to discuss the latest IFO survey results, including the German Business Climate Indicator. And this could be fascinating. Valerie Teitel joins us with a preview of that. The German data then out. And Valerie, we've already heard from investors, and their expectations have been reset by German fiscal plans. What are we expecting from this IFO number, the reading on German business?
Anna will be reading through this data print in just a few minutes' time. If it confirms the positivity that we got out of the PMIs yesterday, which showed business activity at the highest levels in 7 months, a lot of that across Europe, driven by a continued rebound in manufacturing in Germany. Will the IFO data later confirm this recent positivity? Because, yes, there are positives and negatives weighing over the German economy. The negative being the tariff threat from the Trump administration. The positive being that potential spending boost, the infrastructure spending, helping drive manufacturing and maybe driving more private investment back into the German economy. We'll be watching to see if that IFO print today confirms the more hopeful ZEW and PMIs yesterday.
All right, Bloomberg's Valerie Teitel. We look forward to that data, and of course, you breaking it down for us. We thank you so much. In the meantime, we are also going to be talking about Shell. You did have some lines coming out early this morning. They are changing some of their buyouts. It is one of your best performers this morning, actually moving not only the FTSE 100, but moving the Stock 600 as well in terms of upside index contributors. We are lucky to be having a conversation with the CEO, who will be speaking to Bloomberg later today. That coming up on the Bloomberg Close at about 7 p.m. London time, 3 p.m. if you are in New York. And that, of course, are some shares that are moving pretty significantly this morning.
Yeah, the stock up this morning. And European equity markets broadly are up then, up by 0.5% on the Stock 600. We are looking for the latest tariff news headlines, as we are on a daily basis, it seems. US futures point a little bit lower than Lizzy, down 0.2% on E-minis.
Yeah, and not much difference between the FTSE and the Stock 600. I'm going to grab a water.
Yeah, that's a good idea.
The Pulse is up next. That does it for the opening trade. This is Bloomberg.